JP Morgan's Jamie Dimon said the effect of these bank failures, Silicon Valley, Signature Bank, will be felt for years in the US market. And he said regulation is partly to blame. For one thing, he thinks stress tests weren't updated enough to take account of rising interest rates because, of course, Silicon Valley Bank piled into apparently safe US government bonds, but they drop in value when rates rise. What's ahead in banking in the near future? We're joined by Randal Quarles, former vice chair of the Federal Reserve. It's great to see you.
Thanks. It's good to be here.
Silicon Valley Bank, it occurred so rapidly. Was that partly because a lot of its money was Silicon Valley types who yanked their cash out fast?
So I think that's part of what has to be investigated. It's certainly true that the uninsured depositors, which was the bulk of the depositors at Silicon Valley Bank, behaved differently than history would have led us to expect. The money moved out more quickly and in greater volume than had ever happened before. Now, was that because of the nature of the depositors, that they were concentrated in the VC and startup community in Silicon Valley? Or was it because of the nature of deposits in general in a world where all of us can see every rumor instantly on our cell phone and can act on it instantly by pushing a few buttons and moving our accounts? And those are two different conclusions that would call for different responses from the government.
Have we ever seen anything like that before, though? A bank's portfolio was high quality. It was government bonds, but the wrong interest rate call put them offside.
Well, that's actually a reasonably common risk in banking. I sort of began my first foray into policy 40 years ago in the savings and loan crisis in the United States, where you had a very similar situation. You had institutions, our savings and loans, that had very short-term liabilities, their deposits, and very long-term assets, their investments in mortgages that were very sensitive to changes in interest rates. And when we had the inflation of the 1970s, that essentially killed that industry because of the changes in value of their assets that were driven by inflation and the changes in interest rates.
So it wasn't, sorry to interrupt, it wasn't so much bad real estate that they were buying. It was simply the duration of the portfolio.
It was the nature of the assets that as interest rate rose, those very long-term interest rate sensitive assets would lose value at the same time as they're having to pay more for their deposits. So a similar situation, a much bigger issue because it developed over a longer period of time and the interest rate moves were larger. But I think, so it's something we've seen before. I do think that the regulatory structure that was put in place immediately after the great financial crisis was not as sensitive to these risks, which were very much in the rearview mirror at the time that regulatory framework was created. And it was focused on what were the particular risks in 2008, which was a shortage of capital. And they didn't really focus a lot on these key interest rate risk questions. Those are fundamental issues about banking. They've existed for hundreds of years. Yes. But I think there were aspects of that regulatory framework that could be improved going forward to reflect that issue.
The 07, 08 was about a lot of things, but that was partly about bad assets, wasn't it?
It was very much about
mortgage bonds.
Yeah, exactly. It was about bad assets. It was about excessive credit. It was about poor underwriting, and and the framework reflected all of that.
So we've heard it's become a cliche now. Banks are becoming more cautious about lending, and that's just reinforcing the Fed's monetary tightening policy. Is that going to be with us for a while? Banks will be nervous about putting money out?
Well, I think, so you have a couple of issues in the U.S. banking system, very different than the Canadian banking system, of course, because you have these thousands of, very small banks in addition to then a handful of large behemoths. And those thousands of very small banks are very important to the dynamism of the U.S. economy. They make credit extensions to smaller businesses that often the larger banks won't. And it's that cohort of the U.S. banking system that's under pressure now as a result of Silicon Valley Bank. The deposits have been leaving the smaller banks and going into the larger banks. And so that puts pressure on, again, what's an important part of the banking system in the United States. Entirely different issues and structure than in Canada. And so that, that's abated for now, but nonetheless, that move is not reversing yet. And so that important element of financing small businesses in the United States remains constrained. That actually will help the Federal Reserve's monetary policy objectives in seeking to constrain demand in the economy, but it does create some long-term issues for how the U.S. banking system will operate if it doesn't reverse.
Is that so? You have thousands of banks in America. You always have to overdo things in America. No, I'm joking, but that's very interesting. But some of these banks obviously are locally focused.
Exactly,
and they play a role in lending to local entrepreneurs. Is that a thing we're missing in Canada with our handful of big banks?
Well, it's interesting. At the event I was speaking at earlier today, we discussed exactly that. The Canadian system, with its very large banking anchors, is extremely stable. Again, over the course of my career, 40 years, beginning with the savings and loan crisis in the United States, with the great financial crisis in 2008, with the stresses we're going through now with COVID. The structure of the Canadian banking system is extremely solid, and that's a benefit for Canada. You don't have the instability, but you also don't have what comes with the American system is more instability, but also more dynamism. And the question is, where do you strike that balance? The U.S. now will be going through a process of seeking to rebalance and say, well, maybe we need to aim a little bit more on the side of stability, a little bit less on the side of dynamism. And the discussion will all be about, has that balance been struck correctly? I think Canada could also benefit from a similar discussion, which is, has Canada struck the balance between stability and dynamism correctly?
Gone too far into oligopoly.
Obviously, Canada's system has worked very well for Canada, and I'm not here suggesting that it should be changed, but it is an interesting question.
Sure.